go. Oh, sorry, admit all. Please keep an eye on the admissions if I don't.
خير عموري.
كيفك تمام؟ All right, perfect. Okay. Where's my other phone? Oh, okay. First, sometimes I don't know where I am. Come on. Okay, everybody. Let's do this. I'm sorry, everyone. Unmute yourself and we'll get the session on. Everyone can hear us, right? We're good to go. Now you can see how annoying I am, Tom. Every armor has to be annoying like that to the other armor. I'm pressing it like 1600 times. Okay, خلاص, never mind. Mandur, welcome. Okay, guys. Thank you, first of all, for joining our second session now in investing in your future. This one is going to be called Investment 201, Building Your Portfolio. Now, if you remember last time, we spoke about many things that have to do with the foundation of learning what stocks are, what you are looking at when you're reading the news or hearing what people are saying, things like, what did we talk? Return on interest, or things like sectors, ETFs, stuff like that. So today, we're mostly going to be talking about what you should be looking for when you want to start investing, because investing is not really just about, hey, which stock should I buy? It's more of how can I build a structure or a foundation that I can build everything on, because every human being is different. And just like every fingerprint is different, every set of DNA is different, your investment and your future is going to be different from the other person. For example, your age matters a lot when it comes to investing. The younger you are, they say the better it is. But why do you think that it's better to start investing when you're younger? It's a lot of things. It's time. You have a much better ability to save money as well. You can adapt more towards what you want to do. So let's say if you're a 20-year-old versus a 40-year-old, you're both starting to invest now. Yes, maybe the 40-year-old might have at the beginning more money to invest, but he will have less money in the longer run to keep investing, because yes, he might be making more at a job right now. Let's say he makes, I don't know, 20, 30,000, and he can put a good amount into the portfolio. Later on, bills are going to come up, kids, family, expenses, yada, yada, yada. You're not going to be able to keep doing that. While for the younger person, you might be able to start with, let's say, 1,000, 500, 2,000. But then when you find out how much you want to make by the time your investment goals are met, you can change your life towards that. Yani, you can spend less, you can eat more at home, let's say, go out less, get a part-time job if you're in college. There's different ways that you can help yourself, while when you're older, that's going to be much harder to do, if that makes any sense. So these are some of the things that you should be looking into when you want to start your portfolio. What are you investing for? So let's say some people want to invest short term, few months to a few years. Now, when you think about that, what would you think something like what is that what kind of investment is that? Some people, let's say, want to buy a new car. They don't have the money now, but they want to save enough money to buy it later. Then you'd look at more of the short term goals. Medium term, 3 to 5 years. So let's say while you're in college, you have the ability to save a little money and keep investing it to start your life after you graduate. You don't know where your life is going to be, but you want money to be there for you. So that would be something good to do. Long term, let's say you just got married, you are about to have your first kid. You know, that's something that's amazing, but it's also something that's nerve-wracking. It scares you because you're not just thinking about short-term expenses like what the kid needs, diapers, doctor appointments, expenses, labor, stuff like, I don't know. There's a lot of expenses that come with it. And then when the kid is born, that's a whole different thing. And while the kid is growing up, paying for school and all of that. So one of the things that maybe you can calm yourself down with is knowing that you have a plan. And as long as everything is going towards that plan into the future, you know what's going to happen, or you have a good idea that no matter what happens, I have a cushion. Let's say you want to save up for college for your kids from the time they're born. You don't have to have a little piggy bank or حصالة that you put money on the side, because that's not logical. So what you do is there's different types of investments that you can do that have a maturity. Maturity is when your investment horizon or when you meet your target. So some investments have a maturity of 10 years, 20 years, so that let's say when your kid is ready to go to college, let's say, that investment is ready and now the money is right there. The kid needs nothing. Some people save it for maybe to buy a house. You just are about to get married soon. You're worried about what's going to happen in your life later. But you know that you and the person you're getting married to can live in an apartment for a few years so that later on you can buy a house. And this is what you do. And with every type of time horizon, there's a level of risk that you can also take. It also depends on your age. It depends on a lot of things. But the general consensus is if you're younger, if you're older, let's say, you're more risk averse. So the older you get, the less willing you are to take risks in life in general. And this goes back to something we were saying last time, that all of this, the stock market, investing, all of that is really like your life. It's like a living thing. So the older you are, you're not going to take risks in life. So why would you take risks in your investment? That's where you go towards investments or a type of portfolio that has less risk. So most of the things that you buy are going to be things that are not going to be like one day going way up and the other day going way down, because that means you cannot count on what's going to happen. That's risky. Risk neutral is someone that is, hey, I don't care. If you give me some risk or no risk, I don't care, as long as my investments are good and I'm not going crazy. Then you have the risk taker. These are usually people who invest in things like, let's say, penny stocks. Penny stocks are very high risk. That's where you won't find risk averse people. If someone is, let's say, 45, 50 years old and starting to invest to help his family or for his kids or something, he's not going to invest in something that's so risky that he might lose his money, because in the end, this will affect his family, will affect his kids and all of that. So usually you'll be more risk averse. But risk taker, someone who's 20 years old, you have a couple of $100 that you're like, you know what, if I lose it, I won't lose my sleep. But if I make money off it, hey, I'm rich, you know? These are things it depends on who you are, how you live your life, your age, everything. It depends on a lot of things. So these are some of the things that maybe you should consider. If you first, what are you investing for? How long do you want to invest for? Um, things like what kind of sectors do you want to invest in? Last time we spoke about many sectors and many types of industries that you can be in. So what are the things that you're looking towards? Maybe you're more into green energy and you only want to spend your money on stocks or investments that are for green energy. Maybe you are into your risk taker, you only want to invest in OTC stocks or penny stocks because you think a few of them will make you millions in one day. All depends on who you are. So once you figure that, it will be easier for you to figure out where you want to go or what you want to invest in. Are you here?
I'm here,
Okay, so welcome. Now that we're talking about time horizons versus risk tolerance, um, short term, few months to a few years, short term risk. Who do you think? Sorry. Oh no. Okay, see, I should have. Sorry, my bad. Okay, little to no risk. So this is supposed to be here. So my bad, guys. But short-term investment, it's a few months to a few years, right?
Yep.
Now, what kind of risk tolerance will you have if you're investing for a few months? إذا زوج قال لك أنا أنت عندك القروش دي and وأنت داير مثلا to save it for a wedding at the end of the year. What kind of risk will you be taking to have enough money for that wedding مثلا at the end of the year?
To be honest, I think you'd have to take a relatively high risk because you have to have a blend. You'd have to have like medium risk. So, for example, let's say if someone عنده إرث ونهاية السنة or wherever, he'll probably put maybe like some money into some growth stocks, get some cryptocurrency like itself, or get some cryptocurrency miners, or
something that is more high risk.
Maybe use some technical analysis كده and just like play a Doge game, like when Elon says Doge to the moon, everything to the moon.
Okay.
Or you have also like to have to balance the actual like value plays, as in like reopening plays. So securities.
Yeah, we'll get into that later on, but in a general sense,
so
because now we're just talking in general sense. You'd be a risk taker.
You'll be more tilted towards like higher risk, just to get you those returns, to get you those cash returns. So then you can like take profit, and then have like the actual reserve.
Yeah, that we'll tackle later on. It's just we're going just basic risk versus term. So let's say medium term. You're a person that is only investing from 3 to 5 years. Will you be risk averse? Will you be risk neutral, risk taker?
You'll be between risk neutral and risk taker, because you'll think to yourself, let's say there's a company that's doing like genomics or something, and they have found a way to cut the cost of genomic sequencing, and it's groundbreaking, and it's gonna be something for the future. Then like you might like invest in something like that. You know what I mean? Like a CRISPR or a Pacific Biosciences or something like that.
So you're saying because it's because they already have a foundation of something. They already have a foundation that it's not too risky, but on the other end, the risk comes in from the future, right?
But there's risk, but you feel you're at an inflection point where you're at a point where things are changing. Mm-hmm. Like right now, if you bought Zoom last year and you thought we're at an inflection point, returning to the office isn't going to happen. Like maybe in the future, working from home is here to stay. Then you could have been right. I'm going to get me some of that.
True.
You know what I mean? And take that risk and get a substantial reward.
All right. So if you're someone that is investing for more than 5 years, let's say you're investing for your kid's college fund. Your kid now is 1 years old, so he doesn't need it for another 18 years. What kind of risk will you be taking?
Medium, but I'll be taking it with established companies. I'll be, getting like your FANG or your MANG stocks, which are, your
So
Microsoft, your Facebooks,
so
and
you're
your
going
Apple.
for more neutral, going towards the risk averse, right? Because in the end, this is an investment that is for the long term, so you don't want to lose it from the
Yeah,
first
but
year.
I don't have to take, no, I have a long horizon, but I don't want to take too much risk. I could take a little bit of risk, but not
Mm-hmm.
too much. You want to just have the big players, which also pay you income. So that way you're growing your returns from the share price and you're getting dividends for it. So you want to
That's
have
your
things with,
strategy, yeah.
sorry?
Mm-hmm. Yeah, that's because of your strategy, right? It depends on your
Exactly.
time horizon. It differs. It changes things between each type of portfolio and each type of investment. Now,
Exactly. You
the
can
thing,
see here the Dow Jones Industrial Index, average index here that you have,
mm,
shows you like that, these established names, they may have like their little wobbles, but they always come back stronger. There's always, if you look, as you pointed here in the graph which you extracted, there's always a new high after a
mm-hmm.
fall or a slump or a previous low. Every time
Now,
the market has come back, there's been a new high after the slump or the low.
yeah. Now, this
That's a
area that
very
I'm pointing towards, do
where
you know what time in, like, what point of in time was this
Great
slump?
Depression.
This is the Great Depression. So look at this. If you really think about the market and when people say it jumps up, down, right, left, all of that, this is over 100 years until 2009, right? This is the worst depression in our time. This is like something as finance students, they teach us about it all the time. Oh my God, the Great Depression, it was the worst thing in history. Look at what we did after that. This is going up. So the longer you invest, you kind of the longer you go, the safer you are, basically, in your investments. So never focus on things that, depending obviously on what kind of investment you want, but don't always focus on the daily moves of the market. There's no point in that if you're investing in the long run. And the longer you invest for, the safer kind of is. Now, do you want to talk about, oh, sorry. Um, we have a few people on the, how can I let people in from my phone? I'm sorry, guys. Trying to figure out this hosting thing. Oh, there we go. Okay. Now, types of investments. Um, can you kind of like explain to us what is a growth stock? Are you still with us? I'm looking for no. Okay, so I'll explain it. Okay, growth stocks. Growth stocks are companies that are considered to have potential to outperform the overall market over time because of the future potential. Now, when you think about something is that grows at an exponential rate on a regular basis, or something that a company that everyone's talking and telling you, oh my God, you should have invested in that. I should have invested last year or 2 years ago. Something like an Amazon. That's a growth stock because it is, no matter what's happening, it's just growing. It's growing higher than the market. The market crashed last year, but everyone was still ordering from Amazon. So the company was still growing and growing and growing. And Amazon is not just the delivery service. Now think about it this way. Amazon started as books. They only sell books or send out books. Then they expand into logistics. Now check Amazon and check AWS services, Amazon Web Services. Amazon Web Services is a cloud-based services. They basically run the whole system for companies and organizations. Their major customers are people like the CIA, several American governments. Imagine the whole cloud infrastructure or the basically all the storage that you have and every software that your company or your organization needs and runs on is through Amazon. So you're thinking just same day delivery, 2-day deliveries. They already did something else and they're growing. And that part of Amazon by itself is becoming something that gives them more like almost 50% of their revenue. So they almost make half of their money from something that most of us don't even know about. Now, one thing also about Amazon as a growth stock, I don't know if you all heard that Jeff Bezos will be leaving after the summertime and everything. Now, if you look into the news and see who will be replacing him, it's the guy that made Amazon Web Services grow to the level that it is now. So that's where growth stocks are. Companies that are able to grow and grow and grow, even if the world is crashing, it's not whatever is happening, they're outperforming everyone. And now, whenever someone says outperform the overall market, that means if you take the average of what the market does and see the growth or the performance that it does, this company always just does better than the average. That's what it means. Now, on the other hand, there are things called value stocks. They're classified as companies that are currently trading below what they're really worth and will thus provide a superior return. Now, these are companies that, because of the way the market works, it's like a living thing. Sometimes people buy a stock so much or buy so much of a stock that they make the price go way too high and it doesn't make sense for what the company is doing and how much they're making and everything. It's like, let's say you have a dry cleaning company. 1 month it's making $5,000. The next month it's making $10,000. Third month it's making $50,000. Fourth month it's making 200,000. You're like, wait, this doesn't make sense. Something is wrong here. And that's the same thing with stocks. Sometimes that happens. So when that happens, there is a way to, you can obviously run the formulas, do your calculations, do your research to find out. But when that happens, there is going to come a day where that stock is going to fall, and it's going to fall to basically the point where it's actually supposed to be, or sometimes even lower and then come back up. So what they're saying here, that these companies are already at this level. They're lower than what they actually should be. And the market hasn't caught on to that yet. The market hasn't really noticed it yet that, oh, this company has a stock price of $25 where and actually it should be around 35. So, okay, you know what? This is going to happen soon. The price will go back to where it was. So you go and buy as much as you can of that stock and wait for that day to come. Once it hits
Yeah, I'm
35
looking
or
at that
above,
into it.
you're good. That's what
So
value stocks or what they expect them. I'm sorry, Al?
those would be, sorry, معلش قبل the train signal touch. Those would be two examples would be like General Motors or Intel or Ford or Dell. They're like clear examples, or IBM recently, where something, like you said, became overhyped, overinflated. Then it went back down to earth until they realized, okay, actually there is something here. They are doing something. Like usually what happens with these companies is they get a new CEO, like Pat Gelsinger for Dell, who will come, has a plan, bring chip making back to America, and also now they have the advantage because everywhere in the world has the shortage of semiconductor chips, whereas they can make them in the U.S. domestically and serve to meet the demand within the nation, for example. Or GM now going into EVs and saying by 2035 we're no longer going to have gas and electric cars. That's an example of like something going from like a value stock but with an
To
element
a
of growth
growth.
and depressed over time, as you said.
Absolutely. We also can look at Tesla. Tesla now, everyone from an analyst standpoint think that even though they're almost at 800, as one share is for 800, they still think that it's way lower than what it actually should be, because it's a lot of reasons, and I'm not great at Tesla specifically because they just annoy the hell out of me. But in a
Now,
sense, that's
Tesla is
value
based on
and
the
growth.
data. The data they
It
generate, the data is
Yeah,
invaluable.
but it's yeah. What
And
I want to say is that
the data
it's
that they
way too
have and
much
they've
to explain.
collected, yeah, but the data that they have and collected has changed the world. Like right now, you have autonomous driving thanks to them. You have an underground tunnel in Vegas, which can take you from point A to B to divert traffic thanks to them. The due diligence and the level of acumen and intelligence that they have through Elon Musk and his team to extrapolate innovative engineering from multiple things, from clean energy to space travel to the cars being autonomous to the technology itself, is what's driving this. And
See,
also they have the first mover advantage. They were ahead of the game like 10 plus years ago, but now people are finally getting into that. And plus
you
they can
just proved
scale
my point.
and they're global in terms of their
You just proved my point. You
Sorry, go
just
on.
proved my point that it's a lot to explain,
Yeah,
to
yeah,
tell
exactly.
people why Tesla is undervalued. Do you know what I mean? Like there's literally you have to do for each sector of what Tesla does. You have to take a whole week of just studying what they do. That's what I'm just trying to tell you. Like they are gonna change the world, and they are already changing the world. But even though we're saying that, you can't just go and say, "Oh, you know what? I heard a lot of people say this, so let me go put all my money there." Don't do that, please. Now, ETFs. Can you please tell people in the most general of senses what an ETF is, or an exchange traded fund?
An ETF is an exchange trade fund. It's actively managed by portfolio managers, and it focuses and concentrates on, like, for example, sectors or a particular like niche in the market that you want. For example, if you say you want just exposure to semiconductors around the world, the ETF exists for that. You could just have that to just focus on that sector. If you want to just invest in gold, for example, you can do that via the ETF. And the ETF will
Mm.
buy actual hard gold and gold miners. And you can do this
So,
technology
quick
and anything that
question.
you can think of. Toddler.
Quick question. You say that it's gold or specific semiconductor, or filter it towards semiconductors
Mm-hmm.
or specific things, right? So, what do you mean by saying, like, is it like when you say an ETF and a portfolio manager and all these things? So you're saying, is it a collection of companies that is created by a manager, and you just put your money there or something like that?
Yeah, well, like an actively managed fund, yeah. So, like, managers with track records who identify what they deem as the best or the most promising companies in there,
Company.
established
Mm-hmm.
ones, maybe some growing ones, and they
Mm-hmm.
maybe like have a geographic focus which is global, and they can like maybe take like Taiwan, which is like a leader in semiconductors, and combine that with a bit of Korea, like Samsung, and a little bit of like the US mainly, and then some European semiconductors like ASML, for example, and
Mm.
or
Like,
Siemens or Conkalike or many different kind of things like that, and then combine them all together. That's what
so
they would
let's
do.
say,
Basically, it's continuously priced, so it's
mhm.
always moving the price. So
So
basically, it
let's
trades
say
like
I
a,
only want to invest in, let's say, a clean energy, because we were talking about this a while back. Let's say I only want to invest in companies that are ethical and that are not ruining our environment anymore. But on the other hand, I don't have enough money to invest in the whole like 20 companies. Like, how would I, because I don't want to take the risk also, because if I invest in one company and put all my money there, it could just fall and I'm screwed. But also, I don't have enough money to invest in company A, B, C, D, E. Now, would a ETF like this help me with that?
an ETF like that would help you with it because it will give you that exposure that you want within those companies and within that sector itself. So you're covered by owning that
Mm,
ETF because you can get
okay.
like an ESG like fund, for example, which will give you that ETF exposure for like clean energy, renewable, better planet, better world. There's hundreds of thousands of them out there that you can choose
So
from. You can look at it
basically,
by going.
so so basically, like they just have a collection of these clean energy companies already ready for you, and you just put your money
Yeah,
there and it
it's a sandwich.
disperses towards them.
It's like a Subway sandwich, literally. And then the thing is, like when one moves, it doesn't affect
You
all
make it
the
your
other.
way.
You know what I
Okay.
mean? Because at the end of the day, if one falls like 10% and the others all like are like steady at like 1%, then the ETF itself won't fall by much. That's why you're
It
protecting
averages
yourself
out.
from downside, right? But also you're limiting your upside because you're not going to get as much upside in the shorter term. But over the longer term, over the years, you might get like 6 to 8% return per annum on average. But now that we're at an inflection point with clean energy, you might get more than that until like things start to diminish over time because these things tend to
I'm
be adopted. Yeah,
okay. Basically, so Hadil is saying, so it's like a diversified basket of companies.
exactly. It's like its own index that you've created,
Hmm.
like
What is an
literally.
index?
Yeah, like you made
You
your
just
own.
said index. What does that mean? Is it like so
An index is a measure or a benchmark used to assess the performance of a company or set of companies that of your portfolio, for example. So in a way, you're creating your own like index, your own like portfolio within ETF by
mhm.
choosing things that you like. For example, you can see multiple ETFs of multiple different stocks, for example, clean energy. You can see which ones you believe are the most promising ones. Or and you can also see their
Hmm.
performance, and then you can choose based on that. This one has the best
Okay.
performance. This one has the best
So
holding. Trust these guys.
so
I'm gonna
when you
hold.
open, so when you turn on the financial news, sometimes they say the S&P 500, the Dow Jones falling, blah, blah, blah. Is it those? Is that an index fund?
It can be focused on those. Remember, the Dow Jones is the established companies,
Hmm.
and like your Pepsis, like your Coca-Colas, like your big players, like your what's it called, your General Motors and companies like that. That's like or yeah, that's like a Dow Jones, the established
Hmm.
players. Then you have your
So
S&P,
it's a
which is the
collection.
500. Yeah, yeah. But they're
Okay.
more stable these companies. But they also tend to outperform. Like these are reopening slash value plays. The more
Mm.
growth stocks, for example, tend to be the S&P 500, and they have some established value players in there. So it's a mix between the 500 best companies in the US. And then the Nasdaq is your tech companies, which have more higher growth, more aggressive, more risky, more volatile. So
Your
that's
Apple,
the
your Facebooks, your
yeah,
Teslas, your okay. So okay,
exactly.
so then what is so okay, now let's say we have a couple of value stocks, a couple of growth stocks. I have a couple of bonds here, some ETFs. What is a REIT? What is a real estate investments trust? Like this is come on another thing that I can invest in? Like
Yeah,
I
you
know
can
what
if
it is, but it's starting to get,
if you want exposure to property, but you don't like you can't afford to actually own any. Then what you would do
Mhm.
is you would buy into a company like it would buy a real estate investment trust that owns that owns buildings and like has generates rental income, and then from that rental income, because you own part of the shares of that company which own the real estate, you also have like part ownership, so you're able to like get the rights of like income on a maybe monthly, quarterly, annual.
Mm. So now, okay, your voice cut out a little bit. So it basically, so basically it's like I own a collection of apartments or houses or kida, and everyone is paying rent to those, and then you make money off it, right? But on the other hand, you're not taking the risk of I have to own every one of them. Like Allah said it perfectly here. Let me look up. Oh, that's comments. Uh, okay. A company that owns, yeah, perfect. It's a company that owns property or a variety of them because yani, there's different ways of owning property that can make you money. You can own apartments in like downtown, whatever city. You have two, three apartments and people pay you rent. There's also houses. There's also warehouses like land. If you have a huge warehouse or area for that, some companies might pay you rent for that. There's a company called WeWork that basically used to rent them by the hour or by the day or by the month. So there's different ways of having these companies own the properties. They take all the risk, all the management, all the issues, everything. All you have to do is give them the money to own these things, and they pay you back for it in dividends or in
But also storage
yeah,
facilities.
profit. Hmm.
Storage facilities, like here we have Safe Store, allow you to pay for storage, and they also allow for you to pay. For example, they also have offices that they rent out to people, so they get two forms of income from their real estate. So they have like storage facilities, which they charge for people for a daily
Mm.
rate or weekly or monthly rate or annual rate to store, and they also have offices which they rent out to people and companies, and they generate income from that. And they're like, up and down the United Kingdom, and they're just like
What is
killing
the
it, and they're
company
bossing it.
called?
Safe Store.
Safe Store. Okay, so guys in the UK, look up Safe Store.
So can I
That's one.
add one more thing, Amro,
Please.
to my comment was, I don't know if people know, but McDonald's is rich not necessarily because of their burgers, but because of the land that they own. So McDonald's is also somehow seen as or leaning towards becoming a REIT because of all the
Mm.
land and property that it owns.
Through franchising, you mean, or is it just?
You rent I don't know if anyone's seen The Founder. I recommend everyone to watch The Founder. And it's based.
You mean real estate? Yeah, like they pride themselves as like, yeah, not being just a kind of food chain that delivers, food, but it's a food chain that's built on real estate, and that's how they've managed to capitalize on gains like over the course of 50 years or so. I think there's a statistic as well. So here in the UK, like within 10 minutes of say cycling or walking, there's a McDonald's somewhere. So they've been very strategic in how they've actually gone around conducting their business. So I watched like this YouTube clip of I think it was the CEO of McDonald's talking about how we're in the real estate business, essentially, not the food business.
Yeah,
if that makes sense.
They've been in it for, so they bought McDonald's, they bought the actual name to McDonald's from two brothers. McDonald's owner, who owns it now, was not the founder of McDonald's, but he's the reason that it blew up, because he took it out of it just being in the food business into the real estate business. So when you are paying like for the name, you're also technically paying for the land. So when you franchise, you're not just paying in for the name, but they don't just own the name, they also own the real estate or the land that it's on. That's part of the deal, from what I understood.
That is interesting. So the most franchised company in the world, I think, is Subway. And I think there are more Subway stores in the world than there are Starbuckses or something like that. So I wouldn't be surprised if that's one of them as well, since you guys are talking about it. It just has the same structure.
They also have commodity exposure. They have contracts for cattle, for pork bellies, for wheat, for all these things that they can make themselves. You know what I mean? Which allows them to.
Can you please explain that? I actually like the point, but I actually do not.
So basically,
it kind of went over my head.
They'll have contracts where they can agree prices today. So, for example, if the market is falling, then they can agree to they can agree to buy like the price today and fix it for like the next like year or two. And then let's say if the market picks up again and it becomes more expensive, they've already secured their cost of like their wheat and their cattle or their pork bellies or their chickens ahead of time. And so market goes up, they've already made them. Yeah, you can. It's a futures contract. We'll do that for the next lesson. But they have that exposure, and that's with commodities. You can do that with a company like that, which does mass production of things, would use futures to manage their risk and hedge their costs by doing that.
Wow. So if you guys heard what Amr just said, that just is mind blowing. But I can also see how that can work, because just like with everything, you need prices to be stable for you to make money over a long time. So what these companies basically do is they go to their suppliers and say, hey, you know what? Meat that we get from your cows costs 20 cents per pound. We'll buy it from you for the next 5 years for 20 cents per pound. The price goes up to $1 per pound. I don't care. I'm paying 20. It goes 10 cents per pound. I don't care. I'm paying 20. That's smart. That's smart. I can see how companies can control the cost of making their products, or cost of COGS, COG. What's the cost of goods sold?
Exactly. And also if there is extra cost in takalif, they just give it to you to pay as a customer. That's what, like, same with like VAT. If I add a tax, you pay it. They don't pay it. They claim it back. You pay it.
So, okay. So is that why Whole Foods cost more? يعني مثلا لو مشيت لناس الأورجانيك ديلا and you go buy an apple from them and you go to a regular store, that the price you paid for the apple in the organic place will get you a whole box of apples here.
Yeah.
Is that why?
Exactly.
Okay. That's annoying. That's annoying to know. But what other types of commodities can we use this with? But okay, so let's say, because we're talking about investing and everything, let's bring it back to us, the regular person. No, but for us as a regular person, how easy it is, or how is it complicated to invest in commodities? Because for me, I studied finance, I invest, and I still don't invest in commodities because to me, I don't understand it well. I don't like putting my money in anything I don't understand.
So if you want oil and gas, you buy your Shells, your BPs, your Totals, your Exxons, these kind of things. That gives you that exposure. That you choose the best in the craft and you go with that one. Because also the good thing about these ones, they give you income every 3 months. They'll give you a dividend. So that's why people like them, because they pay income. And also they own like a lot of oil fields and they explore around the world. So although they generate like cost of production,
let's say I want to invest. Let's say I want to invest in grains. Do I invest in companies that make cornflakes then?
Yeah, Kellogg's, McVitie's, companies like that will give you that exposure, bro.
See, simpler than I even thought.
The same with gold miners. You want gold exposure or silver exposure, get the gold miner or silver miner. And you can get companies that do multiple things. So when those ones are all up, they're up too on a more amplified level. So that's what comes with research as well. When you're doing your research and you're seeing what companies are exposed to what sector is booming, that also has an impact on the value of the company itself.
So with oil, I can go for a company like Schlumberger that actually extracts oil.
Sorry, say that again?
Or what was that company called, Schlumberger, that extracts oil?
Yeah, Schlumberger or Phillips 66 or companies like that. Or ConocoPhillips, who also do like the equipment for it. That's an example of that, yeah.
So one thing about commodities that people, maybe it's a general thing, it's not like 100% correlated, but generally they say that if you invest in commodities, it usually goes the opposite direction of stocks. So it kind of protects you if the market is going down. Now, let's say gold. Why is that? Why does that happen? Can you explain to me or to everybody why, if one thing is going down, the other one is going up?
For example, the adverse effect that it might have on a company. So, for example, if the commodity prices are skyrocketing, that might hamper the cost of manufacturing, cost of production for a company to produce a unit. For example, if it's oil and gas, the cost of oil goes up. That means the cost of the goods sold from Shell or BP for the oil or diesel that they dispense to you, or kerosene for the planes, is going to go up, which means your plane tickets will also go up. So that means the airlines will have to charge you more because of that. That has an impact on it as well. So the higher the cost of like oil, the higher the cost of like your airline tickets. So like when you saw, like, for example, when there was oil crisis and like last year, and the price of oil went negative, and Trump just took them all in and stored them. You notice how cheap plane tickets got?
Okay. Interesting. So that's one thing. I actually I wasn't expecting it to go into that direction, but that's actually a very good point and a golden nugget to take in.
And
One
also
thing
another
is
point
that
is that
usually
people have
people tell you
$5
that
Go on.
بالضبط إنه if the market is falling, they say invest in gold. Now, there is an inherent like philosophy towards it that when we were taught was what happens is that it's just that money moves from one direction to the other. Basically, that when people are not as scared or they are more secure in the future and the future of the market and everything, they tend to put their money more in stocks, not in gold and those things. But if something is happening in the market and sugwaga and everything is falling and all of that, gold goes up out of nowhere. And people think that it's just like a flip of a switch. Okay, because this is going down, this is going up, while not realizing that the whole reason for it is because the people that had the money in those stocks see the market falling, so they say, oh no, I need to protect myself, so I'm going to put it in the gold. And that's why these commodities start going up, because if money disappears and goes to zero, these commodities won't disappear. They still need to be traded, they still need to be produced, because our world runs on them, not like the stock market. The stock market
And
does
also
not run our world.
currency, the dollar is pegged to gold. That's why.
Can you please explain more about that?
So as you said, you clearly like put it, at the end of the day, like the value of the dollar is pegged to gold. So for example, if the dollar goes to nothing and we'd stop using it, there would be like they would all have to rely on, okay, this okay, there's no dollars, okay, how much gold do you have, how much silver do you have, how much platinum do you have? The precious metals also are or linked to the dollar. So like you said,
So that's
Yani,
how you will have value in what you have.
yeah, it's a store of value. The gold is a store of value. So in times of like uncertainty and stress, people tend to buy the gold because the gold allows for you to be able to, what's it called? To allow for you to be able to hedge, like for example, the fall in the price of like the dollar and the fall in the price of like the markets, for example. And then when it comes to like uncertainty and high levels of risk, especially with interest rates, then people tend to flood to gold because gold will give them that security. And at the end of the day, if you're not going to get anything with rates being zero, then you might as well have the gold, which at least it can give you a cost and a value, for example, for storage. And if you decide to like sell and liquidate it, it's easy to convert to cash, just like a bond is. Yeah.
Dana kind of said a bit of the same thing. She said, I believe people tend to invest in gold when there are no other attractive investment options.
Exactly that. And then now, of course, you have this rising thing in cryptocurrencies. People tend to like Bitcoin when there's as an inflation hedge. So gold's also like the idea of it is it's an inflation hedge. It protects you from the rising costs of like of goods. Yani. That's why people.
What is an inflation hedge? What does that mean? Can you please explain it?
So inflation hedge, for example, like of like the price of things going up, so goods and services. So like for example, that means the dollar is getting weaker and the value, the purchasing power that you have. So the $1,000 you have today is be like what's it called? Like worth more than the $1,000 you have tomorrow. And let's say everything's just getting more and more expensive. The way to protect yourself from that is when this tends to happen, when there's a rise in inflation, also that's impacted on what's it called the inflation for all things, for example, like precious metals. So for example, if you already have gold or silver or other precious metals, those values tend to go up as well at a higher rate than the rate of inflation, which allows for you to make
so let me ask you this. Since we're Sudanese, now that the Sudanese pound is falling, now if let's say people were able to, obviously we are not able to, that's why it happens, but if people were able to invest in gold, or the production of gold, the investment in gold from Sudan increased, right?
Sorry, say that again. The train bugged out.
So in Sudan, when the Sudanese pound, the dinar, was falling, there was always an uptick of investment in gold, or anything that is related to gold activities.
Yeah.
Is that an example of what you were talking about?
Yeah, because we mine it, but also like traditionally and culturally, we just love gold, don't we? Everything in Sudan is just based on gold. Like our moms wear gold. You get married, you give the girl gold. Yeah,
Hmm.
yeah, you're looking at, like jewelry or just any like form of like trade to make money in Sudan. You'll tend to like
It's
base it
gold.
on gold. And people, if they demand the gurush, they'll take gold as payment. Like that's where we are in Sudan.
There you go. Commodities will always have their value, more or less.
Exactly. وحتى go for example, that's why in Sudan when we get married, لو أنا
Hmm.
مثلا قدمت لبنت ما اديت ست المال واديت الذهب itself بعدين يعني لو قدر الله if she hits the fan, then she can sell that gold فهمت to provide you that financial like
Security.
certainty and security like in rough times فهمت. But that's
Okay.
what tends to
Okay.
happen. So if the family has a crisis in Sudan, what do? The family
Sell
tends
the
to
gold.
sell their gold in order
Hmm.
to allow them to continue to go by. So it's actually in a way it's like gurush that's there, money that's there, but like yani, only when you need it, like an emergency fund in a way.
Okay. That's fair enough. That's fair enough.
And
طيب,
then if, as
now,
you said, they're going up in
mhm,
price over time, that means the value
mhm,
of
that means the value of the gold will keep going up over time. I think that's what he's trying to say. So no matter what happens, maybe the market is falling today, but give it a few
goes
weeks, a few
on
months, it will go
to
back.
add gold to whoever you marry, gold 10 years.
UK, you guys got to fix your connection. I thought you were a developed country. What is this?
I'm on the
والله
train
العظيم.
يا ود الذين مالك يا أخي.
I thought he couldn't hear me. والله العظيم قال ما اقدر اسمعني، قلت اقطع فيه شويه. لا حول لا، خلاص تمام، معلش معلش.
Pretty much I'm in Manchester, so it's all good, yeah, man. So, we're almost home.
والله العظيم دي مشكله.
A lot better.
طيب، اوكي، so خلصت الموضوع الليله. Now it's okay. So if I'm someone who wants to invest, right? I don't have to invest in one thing. That means after what we spoke about today, because we spoke about like 6, 7 different things. Let me see. We talked about stocks. What two types of stocks: growth versus income. We have ETFs, some that are focused on sector, some focused on industry or the market. Real estate, commodities. We didn't touch on alternatives because it's a bit obscure. يعني that market is consistently growing. دايما في حاجة حاصلة فيه. Like these days it's NFTs. Tomorrow it'll be something else. So it's basically something that is, one day will. It's like if you guys remember from years ago, there was the Supreme hype. Supreme literally made a brick, جابوا حجرة كتبوا فيها Supreme, and they sold it for $1,000. That's hype. This happened all throughout history, by the way. So for me, it's never safe because you never know when it falls. There was something called the tulip. What was it called? The tulip something, and it basically made the whole Dutch economy almost crash out of existence because people basically realized one day that, oh my God, tulips are beautiful, they are precious, they are rare. Halas, these tulips are worth more than gold. And then yani, it got so bad, and the hype around tulips, the flower, got so bad that you can actually buy a whole house with a tulip. That's how expensive they got. So it got to the point that it crashed the whole market because tulips are not really worth that much because they don't make that much. I actually have a coin that I got from the Netherlands that they made for that time period. It's the tulip coin. I don't know if you guys could see it, but this is just a reminder that never follow the hype because this is exactly what would happen to you. This was, yeah, a
يا
tulip
عمرك
at
هي
that point was worth £400.
I
That's
just
why
see
you never.
I see the Dow
Mhm.
long term. I don't see a tulip. Did you?
No, this is okay. So this is the blossom tulip,
Yep.
and this is the, I don't know what they call them, an unblossom tulip. It kind of looks like an opium plant, but that's a whole different issue for a whole different day. And okay, anyways, so we have options to invest in a lot of things. One thing about a portfolio is that you should get a mix, but you don't have to get everything on the list. You don't have to, it's not a checklist. You don't have to get this, that, this, that. It all depends on your age, what kind of person you are, how long you're investing for, your current status, your work, your job, how much you're saving, how much you make, what do you want to do with that investment? What is the reason for it? Are you just saving money to save money? That doesn't make sense. There's always a reason for something. So when you want to decide what to invest in, don't focus on what stock should I buy. Focus on building a structure of what do I want to do with all of this? How do I want it to look? How do I, like, if you want to build a house, you're not going to think of the color first. You're not going to think of how many doors you have first or windows. No, you're going to think of the structure. You're going to think of how big of a house do I want? How many rooms? How much space? It's the same thing with your portfolio. Once you build the structure, putting everything together after that will be much easier because you have an idea of what you want to do. I want to open the.
Also, you want to build something which can weather any storm. So when the market goes belly up, you're good. So if the market's down like 7% and you're like up 1%, you found a way to sort of like hedge and mitigate that risk, then you're good. So you want to be able to find the balance to like protect you from uncertainty. So if you just say,
we talk about the market when it's falling, yani, forget the days that are good.
Exactly. It's a long-term game. It only quits when you sell. Like it's a lifelong game. At the end of the day, like there might be hidden value. Maybe the market, as you said, is just not pricing in the value because they're thinking, oh, but, end of the day, shareholders are short-term. They're like, we want cash now. We want this now. They're not thinking this company can deliver the next year, 2 years, 3 years, 5 years. They're thinking, literally, we want our growth now. And that's why, like, for example, you're starting to see like the rise of like these companies with disruptive innovation or something like an Amazon, which doesn't pay dividends because they're always continuously innovating and investing because they want to improve and be the best they can be and just keep growing. That's why they don't pay you a dividend, because they want to spend that money. They don't just think, our shareholders, they just want like money to be compensated for each other. Like, no, forget them. We need to use that money.
They want to invest in our future.
The cloud service, the AWS, improve our Prime services, improve everything, be leaders, get into various things, grow our network, our infrastructure, our income. That's what they're all about, yeah.
Interesting. That is very interesting. So now when we look at Amazon, I love the fact that since we brought it back to Amazon, I just want you to consider a few things that are funny. Amazon is only this dominant in the US. Imagine this company want to start expanding, fully expanding into the rest of the world. When you have Amazon and the African continent, it's gonna be scary. It's gonna be scary. So there's always options. Now, I want to open the floor for a couple of questions.
Yeah, let's go.
I want to give everyone a chance. So whoever has a question, please go ahead and we'll get on it right now. One question for you was Mashiwain at 10 p.m. If I am looking to invest in a stock, how do I check to see whether or not that company is a good investment? What and where do I look? That's one question that came to you from Hadid.
You have to look at the balance sheet, the financial ratios. You have to look at their investor relations page. You have to see what they're doing. You have to do your research in terms of like how they're positioned versus their peers and their rivals. Do they have a competitive advantage? What products are they releasing? What services do they have? Do they have patents, something that's protected, that only unique to them? Do they have like collaborative working partnerships which allow for the company to grow? Like something, for example, be Taco Bell and Beyond Meat. Do you know why Beyond Meat had such a run? Because they're gonna make Beyond Meat is gonna make the veggie tacos for Taco Bell, for example. So you want to look at things like that, like strategic collaborative partnerships, as well as like their leading and strategic like services and products, which make them, like number one in what they're doing. And also they're doing something like ahead of the other peers. For example, Unilever is the best at renewable like energy and renewable products. So, for example, they use recycled plastics to make their things. So, someone who cares about the planet would buy Unilever products because of like their packaging and how they like react with the world and initiatives they've taken to like clean up the world and only use renewable things as opposed to like use things which are just going to be thrown and wasted. That's
That
why
is a
Unilever
good
is
point.
such a strong player. It's not just their
So
product.
always,
Go on.
so okay, so always, I hear one thing when you talk about specific companies. I hear you talk in detail about them, like you know them. So it kind of gives me like summary that I always keep hearing. Invest in what you know. Don't invest in a company that you do not understand. If you don't understand what they do, how their business is run, their future plans, all these things, do not invest in it. There's no point. Are you gonna give someone your money when you don't even know who that person is or what they do? So treat it like you're treating a human being. Am I gonna give you my money if I don't know you? Come on. If you have an iPhone, wouldn't you want to invest more in Apple rather than in Samsung? If you eat McDonald's, would you invest in Burger King? If you wear Adidas, would you invest in Nike? Like,
Yeah,
do what you know.
but you have to also do research on them. Like Samsung has way more things.
Yeah. That is true, and that's been said. Like that's already put out there. But what I'm trying to say is that if it's something that you like and there's a reason why you like it, then that is good. Like that is something good towards the company for you to invest there. Don't invest in something that you don't understand. Don't
Yeah, of course.
understand or something you don't like.
To understand the company. Like Samsung do healthcare, they do electronics, they do phones, they do tablets, they do laptops, they do so many more of the things than Apple do. So, but for me, I would say to someone, buy them both because they're both world class and they're both leaders. Have them both. But I wouldn't say like just one or the other. I'd say choose the best. But if the best is more
That
than
was
one,
not, yeah. No, but that was not the point. My point was just investing in something that you like rather than something that you don't like. It's not like specifically to Apple, Samsung, or McDonald's, Burger King. It's just an example. But when it comes to starting your investment, now هسه انت قلت invest in both, صح? Let's say I only have $2,000 to invest. This is my first investment.
yeah.
What would I want to invest in? Apple, Samsung, what else? Give me a couple more companies from those, like Huawei, whatever.
No, Procter and Gamble, Costco, Home Depot, stuff like that. Yeah, I had Madmoon that paid the income as well.
Now, yeah, but see, now this is what I want to get to is that if you have a limited amount of funds, how many, like, what is the general consensus, or how many stocks would you need to buy for that to be a good investment? Because if I buy one share, if I have $2,000 and I buy 2 shares of Apple, 2 of Samsung, 2 of Unilever, 2 of I don't know what, 2 of that, and they all start growing, I'm not going to see any returns. But if, let's say, I break it down in a way where I know, مثلا, okay, I have a full year of a portfolio for a full year. These are the companies I want to invest in by the end of the year. Then, okay, my paycheck or every investment I make every month will go towards something. Let's say this month, I'm going to make sure I don't have, let's say this month I have this amount of money and I can afford to buy 100 shares of Apple. Or I can buy 10 shares of each. Or no, sorry, 5 shares of each. And for me, and this is what I'm going to start doing with my own investment portfolio, I'm going to focus on getting at least 30, 40 shares or 50 shares of Apple, let's say, because once I have a solid base like that, and then I put money into something else, I know that whatever happens with the Apple, if it goes up by 1 cent or it goes up by $1, it makes an effect. While I'm growing the next one. Once I'm done with this, I grow the next one. And that's the way I'm looking at my strategy. But again, everyone's strategy is different. It's like a fingerprint. Everyone is different. For me, because I want to invest in the long run and I want to make sure that I'm not going too crazy with the risk and everything, this is what I'm thinking about doing. But there's also the theory that I was talking about a couple of minutes ago, which is buy 10 of each, build a base in all of them, and then start growing them all at once. You know, everyone has their.
I would say make a target portfolio. So have a few that you want, and then what's it called? And then from there, once you've like built those positions, as you said, your 30, 40, 50, 100 shares and whatever ones you want, then branch out, expand. Because what you can do is once those stocks you have had a run, then you can take some cash from them, some gains, and then you can use those gains to establish a new position in something else that you also like.
Smart.
And then you do it again, rinse and repeat. Imta.
Oh,
and then
that is very nice.
That allows you to have cash on the side. So when things are like the way they are now, when you're getting slapped in the market, then you have cash available to just buy the dip, average down. And, you know, when the market goes back up on a bull run and the things pick up, then you're in a position where you'll get, you know, superior returns.
And to everyone, I hope you all know what a bull run is. Don't come to me later saying what a bull run is.
When the market is going up and there's euphoria and everyone's just buying and things are just rising.
Now, Dan is saying, why don't you mix short and long-term investments? For me, I am doing that. My short-term investments are very risky. So I don't like talking about them because I don't want to encourage them, because it was a personal choice that I made. And I had to like sit down and like really tell myself, Esma, you have to be patient. These are very risky ones. That's why they're short-term. But I also, on the other side, I have a different portfolio of just long-term. Things that I'm comfortable with, things that, as Amr said, I take my gains from my short-term ones, the risky ones. If they make money, I take it, put it into that one. If they don't, I just take the loss and cry about it and angry text in the group chat, which I do a lot. Only when the market is falling, you hear from me in the group chat. When the market is going up, I'm quiet. But that's me. As a credit holder, you have guaranteed return, so it's less risky as investor. Can you please elaborate on that, Dana? As a credit holder, you have a guaranteed return, so it's less risky as an investor. Oh, okay. Yes, that's when you buy bonds or you buy things that are basically loans towards companies. The thing about them is that it always depends on who you're buying it from and what that company is, because the higher the percentage that they're willing to pay you back as credit, the riskier that company is, or that entity is. Yani, let's say, would you be a creditor to the US government or the Syrian government or the Sudanese government, or a government where their financial situation is not guaranteed? Yes, these two might pay you like 20% back, and this one will pay you literally 0.5% back. Now it's at 1.7% back. This is still safer for you, and it's tax-free and all of those things. So it depends. Always consult a financial advisor. Always know what you want to do. Don't follow the hype. Does anyone have any other questions or suggestions or things you want to know? Because, we're going on an hour. No, we just hit an hour. So I'm like maybe 5-10 more minutes if anyone has any questions or. So we're good to go? Okay, everybody. Thank you so much for your time. This has been fun. You guys get to see my room today and Hermes. So yeah, if you need anything, please let me know. Investments take a long time, patience. knowing what you want to do, just like the rest of your life. Treat this as a living entity that can grow, that you're investing in because you're investing in your future. You want to be wealthy in the future or in near, far, whatever. You have to make sound financial decisions, which means you have to save money, spend less, or spend smartly. Don't overspend on things in mafila da'i. Once you start investing and getting into it, you by yourself will stop wasting money. That's from my experience. I used to go on Amazon and buy things I don't need. Now, every time I want to buy something, I look and I go like, or I can have 20 more shares of this company and then I'll hit 100 shares and then I can focus on the next. And that's what happens with me all the time. So now I don't spend any money. I don't have money to spend on myself because it's all in my investments. And I'm happy about it. So worth thinking about. Thank you all. Hope you have a good day. تصوموا تفطروا على خير. And on to the next one. See you next Thursday.